Hi, good afternoon, everybody, and welcome to our April 2025 quarterly market update. I am Matt Saneholtz, along with Chad NeSmith, and we are here to provide some education on what's going on with the markets. Today being April 15th, we first want to make sure that you have paid your tax bill today, whether that's on extension or that you owe the U.S. government. Please make your payment today. Some important disclosure before we really dive into the market and what's been going on the past few weeks. We've had a really volatile last couple of weeks, and so we're here to share some general information, some general strategies, but do remember that this is not personal financial advice. If you have questions about your portfolio, how you're positioned, your retirement plan, your savings plan, please call us here at Tobias Financial Advisors, and we would love to walk you through where you're at on your personal goals and your personal financial plan. In addition, just some housekeeping, there are the slides in your webinar, the slides that we're going over today. You should be able to access them through the webinar platform. And also on the platform, there should be a way to give us questions. If there's time at the end, we will try to address any questions that you may have for us today. Again, my name is Matt Saneholtz. I am the Chief Investment Officer and a Senior Wealth Advisor here at Tobias Financial Advisors. Believe it or not, I've been with the firm almost 20 years this year in 2025. So I've weathered some ups and downs in the markets, and I'm here to help navigate those markets for you and the rest of our clients. Personally, I've been inspired by the recent Masters Golf Championship. I'm committed to playing more golf, and I'm excited to do that.
Oh, that's great. That's great, Matt. I think we were all watching the Masters on Sunday, and with the market as volatile as it was, Rory's golf game was equally as volatile, because I looked 1 second and he was in the woods, 1 second he was missing a putt, and 1 second he was hitting it within a foot of the hole and winning the tournament. So it was all over the place, but I really enjoyed watching it, and it was a really, really great tournament. But I'm Chad NeSmith. I'm portfolio manager here at Tobias Financial Advisors. I've been here just over 4 years now, and I've got my Tobias degree, good Tobias college degree with 4 years of experience. And I do trading and research for the firm, and I do these webinars every quarter. And some clients meet me outside of that, but most of the time I'm behind the scenes doing research and doing day-to-day operational trading for the portfolios. So happy to be here and happy to present with Matt.
Excellent. So there's a little bit more about our firm. We're Tobias Financial Advisors. We're celebrating our 45th year in business, founded in 1980. We're a personal financial planning firm who manage about $900 million of assets across our various clients, which range from business owners to professionals to retirees to doctors, folks going through life transitions, whether that might be a divorce or unfortunately maybe somebody recently passing away in their lives. We are here to make the financial world provide more clarity, and the way we do that is we do believe in a team approach, and we believe in education. We have 9 certified financial planning professionals on our team, as well as Chad and I are CFAs, which is Chartered Financial Analysts, which is a specialist in portfolio management. We have CPAs. We have folks who are specialists in exit planning for business owners. So we really believe in providing an educated approach to your finances. Over the long term, we've helped many families live the lives they want, and we do it by developing really deep personal relationships. So if one thing you're going to take away from today is hopefully that will give you some knowledge on what's been happening in the markets, but also focusing you on what you can actually control. We can't control the latest headlines. We can't control the tariffs. We can't control the market reaction, but we can control building a diversified portfolio that reduces your expenses, has an eye on the tax man, and also is structured appropriately to help you fit your personal goals, whether that be owning a second home someday in retirement or sending your grandkids or kids off to college. So we're here to provide the idea of using the building blocks that we have access to building a structured portfolio that works for you and your family for your lives.
Well, we've got a really exciting agenda for you today. We're going to start out with the 2025 market review. We've only had 3.5 months of performance data, but we're going to look at the first quarter, and it's been a really exciting quarter at that. Then we're going to look at asset class returns, and then we're going to look at historical market performance when you go over the 1 to 5 to 10 to 20 year time period. Then I have some, one chart just has slightly more updated performance data, just because we had so much happen in the first week of the market with Liberation Day on the 2nd of April. The market reacted on the 3rd, and then we had just a week and a half, 2 weeks of volatility within the market. So a lot has changed since the end of March. And then we're going to dive more deep into some more focused topics. I'm going to speak a little bit about tariffs, and then I'll pass it off to Matt to talk about staying the course within your financial plan and what you can do and what we are doing in portfolios. And then we'll round it out with Q&A, and then we're going to just talk about pros and some things that we're looking at on a positive note, and some things that we're looking at that we may be more cautious about with going into the rest of 2025. So looking at these returns, as dated as they are, they're 2 weeks old. As of the end of March, the U.S. stock market was down just under 5%. International was up 6%, which is kind of about the levels that they're at right now. The U.S. stock market's down around 8% right now, and international still about 6% positive to the positive side. Emerging markets were up about 3%. Real estate up just a little bit. The bond market was up just under 3%. That's pulled back a little bit now, just over 1% return year to date in that asset class. And then global bonds were flat, relatively flat for the first quarter of the year. Pulling back in a longer time horizon, this is from March 2024 to March 2025, so a rolling year. That's why these returns are different. The U.S. stock market was up 7.25%, just about 7.25%. International up 5%. Everything was kind of green here. Emerging markets up 8%. Real estate up 5%. Bond market was up just under 5%. And so a really nice positive return we had from March to March. And then backing up over 5 years, the only red blip on this is the U.S. bond market, which includes that 2022 year where we were down 13% in the U.S. bond market right here. The U.S. stock market very strong over the last 5 years, driven by tech, driven by growth, up 18%, but only 6% ahead of international developed stocks. So that gap is a little bit narrower than most people may think at this point in time. And emerging markets up 8%, real estate up 8%, really solid returns over the last 5 years. And then I want to back out just over the 20-year time horizon. When you think about risk within stocks, especially this year where we've had so much volatility, the longer you hold a stock, the less risk it has. With U.S. stock market up 10% over the last 20 years, which is really close to our historical average. International up 5%, emerging markets up 6%, and that has a lot to do with we have a strong U.S. dollar over the last 20 years. Bond markets giving you about a 3% return over 20 years. So everything's still positive. You're still making money. It's just, every now and then we have these volatile years that we have right now. Now, this is my favorite chart. It just is a shame that it's as of 3/31 and not 4/15 or 4/10 that we have. But the story of the year really is gold. Gold is up 20% this year so far, and this chart reflects 19%. But we really have some strong performance out of Europe. So Germany, Brazil, France, United Kingdom up high single or mid double digits for the year. And that's a lot of the developed market performance that we've seen with developed equities up 6%. Then we're gonna, move down the capital structure a little bit where we have bonds up anywhere between flat and 5%, maybe 4% on the year, where Treasury's up about 3% right now. And as we move down into the red territory, oil, which was down just about 1%, it's really pulled back a lot. We'll see on the next slide. But then we have S&P 500 was down 4.25%. And then we move into the NASDAQ, we move into the growth sector, that Mag 7 sector of the stock market that we've been kind of tilting away from for the last couple of years because valuations got so extended. They came back about 10% at the market lows. They were down about 15 on the NASDAQ. Actually, from top to bottom, we were in a bear market with the NASDAQ for the year. And then small caps at the very bottom, Russell 2000 growth down about 11. So small caps have really been getting hurt in the tariff talks. you would think that domestic small caps would do well whenever we think about tariffs and protectionism, but we haven't really seen that to be the case so far in the market this year. Now, the more fresh data that we have, this is as of the 10th, so this is Thursday, last Thursday, the market closed. On a weekly basis, that's Thursday to Thursday, you can see some of the volatility that we're seeing, especially in oil, down 10% in a week on the bottom left side of your screen. It just highlights some of that volatility that we're seeing, but on the right side, you can see year to date, as we said, gold up 20%. It's really the only asset class that's done particularly well this year. US bond market eking out a little bit of a gain, about 1.25. And then we're moving down a little bit where US dollars lost 7% as of the 10th. So there's a little bit of weakening in the US dollar, especially with the tariff talks. Some outflows we've seen from the United States. S&P 500 was down 10 and oil down 16. So that's going to be great for going to the pump and filling up your gas tank. We're going to see some cheaper prices kind of roll in over the next 30 days on gas prices. But the Russell 2000 down 17. Small cap, those are smaller domestic companies. Those are still United States companies, but not the Apples or the Amazons of the world. That's more in the S&P 500. But it gives you a more clear picture of what we're seeing right now in year-to-date returns. Now, I know that the headlines have been really dramatic this year, and the news has been mostly negative with a lot of the tariff conversations that we've seen in various news sources. But this is just an S&P 500 historical volatility and returns. So it goes back to 1980, and you're seeing in the red, that's the biggest drop that you see in the S&P 500 throughout the year. So top to bottom, the very top of the market that year to the very bottom of the market that year. And year to date, on the far right of your screen, you're seeing from the very top to the very bottom, we saw a 19% drop. And year to date, we're down about 10 right now, and that's as of April 10th, so last Thursday again. But I just want to compare, when you go back in history over the last 40 years, 45 years, you can see we've had other years where you've had that 19% kind of range return. At the very beginning in 1980, we had a 17% drawdown, but the market finished up 26%. You can see the far left side of your screen. We saw it again in 1983, kind of the same ballpark. We see it again in the late 90s, where in about 1998, you're seeing a 19% drawdown. The market ended up 27%. Again in 2003, where we're down 14, we're up 26. Coming out of the great financial crisis in the 2009-10 worlds, 2009 we had a drawdown of 28%. The market finished up 23. So I mean, it's very common that we can have this kind of volatility and still have a positive stock market return. So don't give up hope in your portfolio that you're thinking, well, we're definitely going to have a negative return in the stock market this year, because historically it's not etched in stone. We can definitely, and we still have plenty of time to recover if we get good news, good earnings reports, if the economy holds up. It's very possible that we can have a positive return in the stock market this year.
Absolutely. Well, Chad, the topic of the day. Here we go.
We're gonna
let's dive into the tariffs, please. Enlighten us.
I had to go to tariff school myself, Matt. I had to learn a lot about tariffs because they weren't a thing over the last several years. But I went to school, and here I am going to educate our clients here on them. But what are tariffs? I want to start just broad-based, because there's been some confusion on what tariffs are. I saw a poll that only 45% of citizens know what tariffs are or can explain them. So what is a tariff? It's a tax on imported goods paid by the importer to the government. So in this case, it would be like Japan sending over cars to the United States, and they would pay a tax to the U.S. government to import those goods to the United States. So what are the effects of tariffs and on different areas of the economy? So for governments, it means increased direct revenue. So they're going to get revenue from Mexico, from Canada, from Japan, just on those taxes of imported goods, but it could cause retaliatory tariffs. Meaning China could say, well, we're going to cause a tariff on the goods you import. I mean, it reduces our export, so it could net bring down our revenue on the government side. But in our case, it's not going to be the case because we import more than we export. But for a government that exports more than they import, they're going to have a tax hit on the revenue, all things being equal. Now, for consumers are going to see higher prices in a vacuum when you compare it to something in a vacuum, and they're also going to have reduced choice. So an example that I was thinking of before this webinar was that I love Toyota cars. I drove a Prius in high school. I'll always be a Toyota man as long as the price is reasonable and they don't fall apart on me. They're very reliable cars. But if the tariff goes up astronomically, I may be forced to buy a Ford F-150 pickup truck. And that may not be my style, but it might make financial sense for me. But I will have reduced choice if there's a tariff that's really high that comes through. For domestic producers, that's domestic businesses, they're going to have higher input costs when they import raw materials or partially finished goods. It's going to be costs that they're going to pass through to the consumer, but they are going to have reduced competition. So they're not going to have a competitor that may steal business through cheaper goods or more competitive goods. So it's going to lead to reduced competition, and that goes hand in hand with the reduced choice that consumers feel domestically. Now, for foreign governments, they're going to have strained relationships. That's also our domestic. It's just a strained government relationship between the United States right now and a bunch of different countries. Now, Trump is working on getting deals negotiated, which we're very hopeful for, and we think that there is an upside that the market may not be pricing in, that we'll talk about later in the presentation. But going forward, the relationship isn't necessarily as rosy as it used to be. And for foreign governments, even though the tariff causes inflation in the United States, it's actually going to reduce inflation, all things being equal, in the country that exports goods. So that was a primer on tariffs. I gave a lot of information there, but now we're just going to look historically on the rate that the United States has charged for tariffs and the tax on imports, going back to 1900. So a long time ago. The tariffs were 25–30%. Then they came down drastically as we introduced an income tax in the United States, and then they increased a lot going up in time. And then there was a law put in the early 30s where we had tariffs of 20% during the Great Depression, and then since then they've just been trending down over time. And now we went from tariffs under 5% to over 20%. Now this is as of April 9th. The news headlines change from day to day. We get news all the time. Matt and I talk about it all the time. Did you hear about what happened on this channel or something that the secretary has said about tariffs? We think that the tariff rate is going to come down over time, and deals will be negotiated. And I think that this rate is the worst of it pricing in right now. But this gives us good context on what the tariffs were and then how drastically they increased overnight effectively. And that's why we saw a lot of the panic in the market.
Which of course, as you just mentioned, the news, they've already been rolled back, some of them, and we're hoping for some more negotiations as we progress during the next few months, really. But I will continue on to the next slide to show us how tariffs are, what the U.S. looks like as far as an importer versus exporter.
I love this chart. Yeah, I love this chart, and it really shows who holds the cards here and who has the bargaining power. Because the U.S. is the largest importer of goods in the world. When you look on a dollar terms, we're looking on the left side of our screen here. The U.S. imports over $4 trillion of goods every year, but we still export a lot. We're the second largest exporter in the world. A lot of this goes to Canada and Mexico, but you would think about us being net a large importer, but we do make a lot of things domestically and we send out. And then you can see China is the largest exporter in the world, but they do also import a good amount. And then it really drops off after China, Europe, and the United States. But you can see trade as a percentage of our economy shifting to the right side of our screen. Europe, as a percentage of their GDP, imports and exports almost 100% of their GDP. So they're very reliant on trade for growth. If there was a shutdown in global trade, Europe would hurt the most. It would cause a structural damage across their economy, much greater than it would anywhere else. Mexico is highly reliant on us for trade. So it gives us a lot of bargaining power when we negotiate these trade deals, as Trump has negotiated one with Canada and Mexico, our two largest trade partners. But as the United States was the highest importer and exporter, we saw on the left side of the screen, the United States is now the lowest as a percentage of our GDP as reliance on growth, because we have such a strong economy domestically. We actually have a lot of bargaining power when it comes to trade, and that's something that's underplayed in the media, especially that I'm seeing right now, and that may be part of Trump's strategy with initializing these tariffs, that he would use this as a bargaining chip. We're going to talk about GDP forecasts. So what we had was going into Liberation Day, going into the tariffs, we had GDP that was expected to be a little bit slower than trend growth. So about 1.4% when you average out Goldman, Citi, Deutsche Bank, JP Morgan, Barclays. These are big banks with very smart economists, much better economists than I am at predicting GDP growth. But going into Liberation Day on the 2nd, they were forecasting an average of 1.4 GDP growth. And on the 4th, that was the Friday after the Wednesday Liberation Day, we saw an average GDP estimate of 0.3%. And that was after the hard headlines hit, before we had any of the kind of walking back of the tariffs. We saw a ton of volatility in the markets. This was almost in the peak of panic, really. The market bottom was on the 8th. And so this was the Friday before the Tuesday market bottom that we saw earlier in April. And so this is kind of a worst case scenario where a lot of economists are saying, hey, all these tariffs are really going to cause just a 1% drag on GDP. But we're still going to have positive average GDP when you think about it. And so there's a lot of uncertainty, but we're not talking about massive declines in GDP for our economy and growth. It's just a slowdown. And so that's something to keep in mind when you're looking at all of the headlines and all the media throws at you and all these stats, is that we're a resilient economy at the end of the day. Speaking of being a resilient economy, I have just one slide on an economic update just to give you a picture of where we are right now in the economy. And then we're going to swap over to one more slide, and then Matt will talk a little bit about what to do in the portfolio and what we're thinking about. But we are thinking that the Fed is going to cut rates, but they're going to delay the Fed, most of the cuts, until after we see the impact of the tariffs. So if we see that we are getting a meaningful amount of inflation, then the Fed's going to hold off on rate cuts, but eventually rates will come down. That's the expectation, and that's what the market's pricing in right now. The economy the job market is still very strong. We added 228,000 jobs in March. A lot of that's driven by healthcare. About 25%, 25% of that was healthcare, which is pretty resilient to economic downturns. The unemployment rate is still very low at 4.2%. We were up from 4.1 to 4.2, so nothing really dramatic there. Full employment's 6%, what would be considered historically full employment. So we're still really strong on the unemployment rate. Inflation, which has been the talk of the town since 2022, is now under 3%. So core inflation up 2.8% year over year. That's going to continue to trend downward for a little bit until we see what's going on with these tariffs. And then also with rates being as high as they are right now, home builders are still building. So housing starts are up 7.5% where they were last month. So we are getting home builders building. We're getting production on construction. So that's great news. So while the economy may slow from tariffs, we have a strong base to start with. And I think that's a really good point. Now, this is a chart that talks about consumer confidence. And this is just how consumers are feeling. And then it takes the forward year, the 12-month return after the fact of how the consumers are feeling that way. So for example, when we go to November of 2008, in the bottom of the great financial crisis, consumers are feeling really bad. And the consumer confidence index was about 55 or so. But that was in November 2008, and then you fast forward to November 2009, the market was up 22%. And so you can look across, going back to 1971 at the very bottom, when the consumers were feeling their worst in 1990, in 1980, and obviously 2008, and in 2022. You can just look at the average of these things, and you can see that the market has performed really well over the next 12 months. And then the kind of somewhat the opposite happens when the consumers are really confident. Markets tend to be either pretty good or slightly negative. Nothing major here along this graph, but it's just to show that because consumers are feeling bad, we typically have good pricing in the stock market, and it's a good time to stay invested. And it's a good time to just ride through, because this is even though this is the tough period when consumers don't feel very well, and then it's just the time where we see really solid returns, those double-digit returns in the markets historically.
Absolutely. Thanks, Chad. And I have a couple more slides to follow up on that point about staying the course and just going back in history. Chad and I love looking at the data. We love looking at charts. And so we picked out a couple that kind of tell the story of long-term investing. So this one here on the left goes back to 2008, to the great financial crisis. And there's all sorts of different items in the last 17 years that may make you want to make a reactionary move in your portfolio and to maybe sell some stocks. I mean, we're talking about U.S. government shutdowns, the U.S. debt being downgraded. But over the last 17 years, we've actually had a tremendous run into the U.S. stock market. And pulling out even further on a longer term level on the right here, so going back to the 1920s, in the last 100 years, S&P 500 U.S. stocks have averaged a 10% return over the long run. So the stocks for the long run mantra has kept up over the long term. But just picking out some dates and some major events in the market over the time, the 1987 market crash, from that point on, you're still averaging 10% returns if you invested in 1987. The tech bubble bursting back in 2000, maybe a little bit less, but still a positive return since that time period. I mean, the great financial crisis, we talk about, if you can rewind back in that time, we had large, major investment U.S. banks going bankrupt. The system was under attack. And, we're getting some of these questions and like some of the old phrase, this time is different. Yes, the tariffs we haven't seen in many years, as Chad pointed out in his historical chart, but we have seen upheavals and very uncertain times. COVID shut down the U.S. economy, unprecedented, and we made it through that as well. And so this tariffs and how they will ultimately react in the market and to the economy, it's unknown. We do know that staying invested is very important to your long-term plan. To follow up on that point as well, this goes back for the last almost 20 years, 2005 to 2024. We often get calls, more recently than not, about making changes to the portfolio and selling some stocks and getting conservative. It's very often happens that the worst days in the markets are also followed by the best days. And so this is just some statistics of saying if you invested 100,000 and you stayed invested for the last 20 years in the S&P 500, you'd have over $700,000 of return. But if you just missed the 10 best days because you're out of the market and trying to time the market, you would only be up 328,000. So your return gets cut in half by trying to time the market and missing those best days. And so what we are here to say is that investing for the long term and having a diversified portfolio is important, and getting it right is next to impossible. By the time you figure out that the economy has turned around or all the tariff deals have been made, the market has already recovered. The market is a discounting mechanism and tries to forecast price movements 6 to 9 months in advance. And so by the time you get the all clear from the newspaper or the headlines on the news, it's likely that the market has already turned around and you've missed out on the recovery. So what can you do, or what should you be doing from our point of view and your financial plan and your portfolio? Check your emotions. Fear is normal, but don't panic. We all, humans, markets, they don't like uncertainty. But we do ask you to take a deep breath and to avoid the urge to make a major market move, one that could necessarily disrupt your financial plan in general. We've heard stories, we've seen stories from when folks sold out back in 2008, 2009, and they missed the run up, as I was just describing. Their portfolio didn't have the chance to recover because they weren't in the market. Mentally, if the headlines and the social media and everywhere you look is about tariffs, take a break. Take a break. Simply take a break. Go take a walk. Go get some exercise. We're not advocating to put your head in the sand, but you could also at least kind of take a break from the hysteria, because as we know, things are changing on a day-to-day basis, on headline to headline. And if you recall, just last week we had the rumor day where the market was up, was down, a couple percent, then it was up about 5%, then right back down because it was a rumor. But then a couple days later, the tariffs were removed. But that's a whole different. We've all lived it, but just
can't time it.
Absolutely, Chad. We just can't time it. So additionally, keep your politics out of your portfolio. Over the long term, what we just called out, we've seen the market recover and capitalism work, and companies being able to innovate and succeed in any type of economy that we've seen over the last 100 years, which have, of course, been led by Republicans, Democrats, and all types of political parties. So let's not use your portfolio to vote or have to use your politics in your portfolio. Some more concrete things to do is, let's think about purchasing. Chad maybe will want to get his F-150. If you were going to make a purchase anyway, say you were going to upgrade your phone, your new computer, your computer is 10 years old, even those are maybe exempt for now under today's rules, it might not be the worst thing to take a look and see what you can maybe make now or purchase now that wouldn't necessarily be a rush decision, but more of a precautionary purchase. Again, if you were going to buy it anyway, you could consider buying it now rather than in 6 months from now. Review your emergency fund and or access to funds. So emergency funds is that savings that we like to recommend that's not even tied to the stock market. Let's make sure you have something on the side just in case the portfolio does have some zigs and zags this year, but also access to funds. You could talk to our financial advisors about potential margining your portfolio, which means borrowing against your portfolio. It also means maybe looking at your home equity and figuring out a way to put a home equity line of credit on your home. Just again, maybe not to use, but just to have in place if there are some definite bumps in the economy and the markets. Always a good idea to reach out to us to revisit your retirement plan or savings plan in times of market upheaval. Let's confirm we're both on the same page and that you've outlined your goals as best we can into your long-term forecast. And whether you're in retirement or still working, it's a good opportunity to look at your savings plan, look at your 401k, make sure you're contributing. Maybe you want to even up your contributions because we are experiencing some volatility. So really take a look at what you can control at the end of the day, and we're here to help you look through and think through some of these things. In fact, we just put this out this quarter, and I guess timing's everything. We have a checklist that we just issued on our blog. We have our QR code here. We'd like to go ahead and scan that QR code, and you'd be able to download a checklist of certain things you may want to consider doing or checking on when there's a market correction or if we have a recession. Things about what I just mentioned, emergency savings or redefining some of your goals. We have a checklist here that's very helpful. Our advisors would love to walk you through it and kind of see where you're at personally, where we might be able to find some really good planning ideas that make sense during this market volatility. And finally, finishing up on kind of staying the course here on what you can do and what we're doing. What we're doing is maintaining diversification. We, from the beginning, we don't put all of our eggs in one basket. We don't put all stocks. We don't put all bonds. We develop a portfolio that makes and suits your needs. I just love this chart because, as we're saying, over time, the market rewards you. So just quickly on this chart, like stocks on a 1-year basis dating back to 1950, on a 1-year return. They've been as high as 50%. They've been as low as negative 37%. Bonds also volatile, not as volatile or as frequent, but you're also seeing a 33% upside and a negative 13% downside. And a diversification, a balanced approach between stocks and bonds, you dampen some of the returns for less volatility. But the whole idea then, as we're investing through time, and this chart just over the 5-year rolling periods from 1950 to 2024, 5-year, 10-year, 20-year period, on average, you're positive. If you stick to a diversified portfolio, yes, there are going to be some up years and some down years, but on average, over these different time frames, you are positive. So over a 20-year rolling time frame, your average returns between 5 and 15% over the last 70 years. So we're used to volatility. We expect it in the short term, but over the long term, the diversified approach and keeping your money invested and buying into the stock market in down years has been an rewarding situation. So what are we doing? Just some quick definitions of some of the terms that we love to use. Rebalancing the portfolio. Rebalancing is what Chad does and our trading team do on pretty much a daily basis. We are looking at our portfolios and seeing where we need to make adjustments to get back to the preferred target allocation for our clients based upon your risk tolerance and your goals. So on downside volatility, maybe the bonds in your portfolio have become a bigger portion of your overall pie. And what we'd be looking to do then would be sell bonds and buying in stocks. It is something that's not intuitive for a lot of clients in their investing. When the markets are down and the headlines are scary, a lot of people do not react to buy stocks. But this is what we do: is we rebalance. And that is the definition of kind of rebalancing, making some purchases, selling what's been doing well, and buying maybe what's not been doing as well. Additionally, tax loss harvesting, we are been very busy with doing this as well. And this is in taxable accounts. If you have investments outside of IRAs or 401ks and Roth IRAs, this is for brokerage or investment type of after-tax accounts. We proactively look for losses in those types of accounts. When you do that for tax purposes, you are able then to net a loss that you take versus gains that you have in that tax year. What we do is we sell a position that might have been maybe down, or whether that be because of the market most likely, and that we take that loss and we don't just put it into the cash. We buy something that's still investing, that still has the chance to return when the market goes up. And so we do this overall constant rotation of looking for opportunities to take losses from a tax standpoint. And I can tell you what, from experience, we've seen it over and over again, getting back to COVID, back to the financial crisis in 2008, 2009, when we've banked these losses. If you don't use them in this tax year, then they can move forward to the next tax year. So imagine having these losses coming into the tax year in a year. Maybe you sold your business, sold your home, maybe you needed to raise money in the portfolio. We bank these losses for your tax purposes, which don't show up in your returns. They don't show up as if we tell you you're up 5% or 6% in a particular year, the tax losses that we're banking and saving you on your specific tax return aren't calculated in those numbers. So this is an additional benefit that we're not buy and hold investors. We're proactively rebalancing. We're proactively tax loss harvesting. So I just wanted to share those terms and just reiterate, some of the things we're doing on our side that we're doing on a consistent, proactive basis.
Yep. Now, I will say that with the volatility, I was running tax loss harvest screens every day for the month of April. I mean, usually we just had so much movement in so few days, and even intraday movement, which was pretty wild with the rumor day, Matt, that you mentioned earlier. But I'm gonna talk a little bit about portfolio positioning and just give you an idea of what we're thinking about portfolios in a general sense. We'll talk about, on the left side, we'll talk about fixed income. What we've done is we have shortened duration this year. So we bought bonds, for example, let's say we had bonds that matured in 7 years, and now we may own bonds that mature on average in 5 years. And what that does is, as we've seen a lot of interest rate volatility, the price on those bonds do not move as much. So it really holds, it reduces the risk within the bond portfolio. And we're seeing short-term rates stay high because there's expected tariff inflation that we're not really taking much of a haircut on a yield perspective to reduce that risk in portfolios. So we think it's a really good movement in client portfolios. We are staying very high quality within our bonds. We're not really venturing out into the high yield space. We saw a lot of volatility there in April. I was seeing down days of 1.5% for high yield bonds in a single day, which is a drastic move in that space. And we just haven't seen the what's called the spread. We're not getting paid enough to take that risk yet, but we are monitoring that all the time to see if we want to kind of eke out some additional yield to take that risk, to lend that money to those companies. But there's a lot of uncertainty right now, as you may have heard. So we're just monitoring it all the time. Within the stock portfolio, we are rebalancing where it makes sense. So in 2023 and 2024, we were net sellers of stocks when you added everything together because the market was up. We were buying bonds. This year, we're going to be probably net buyers of stocks because bonds have outperformed stocks on average. For domestic stocks, that is. International stocks have done really well. As Matt mentioned, we tax loss harvested where we can. We're doing it all the time, and we're prioritizing really strong companies and really good balance sheets, not a ton of leverage. We do maintain that diversification sleeve within the stock portfolio. So we have the international, which has done really well, that's held up portfolios this year and really reduced overall portfolio volatility. And a lot of our clients are really surprised when they look at the performance of their portfolio and it's not down as much as they may have thought. We're seeing that as a consistent theme in client meetings. Within our opportunistic sleeve in the portfolio, we had about half of it in floating rate treasuries and about half of it in real estate. We've reduced that real estate position. We've cut it by 50%. And we've introduced hedged equity. And this is domestic US stock allocation. We wanted to diversify out our equity exposure within that sleeve. But with the hedged equity position is you're buying US stocks, but they're selling options and they're selling insurance out to the overall stock market, and it's creating additional income that will help us if we were to have a flat market or if we were to continue on a downward trend. We're just going to get paid income to take that risk in the portfolio, and it's going to hedge out risk in the overall allocation, and I think it's a really great diversifier within our portfolios and our models right now.
Yeah, it's a great strategy, and we'd be happy to dive into that one-on-one with you to go a little bit more into detail on how that the mechanism actually works. But it is a good diversifier into the portfolio. So Chad, there's got to be some good news out there.
Yeah, let's say we got to talk about some things that we are happy about and we see. And I had this on, I've been mentioning artificial intelligence more and more. I'm in ChatGPT every day. I'm actually seeing day to day these models getting better. I use ChatGPT instead of Google. So that gives you an idea of how often I'm using it, just to get comfortable with it and to stay on top of the changes that we're seeing. But we're seeing some use cases where it's boosting worker productivity. We're going to continue to see that over time, and it's going to be the workers that really learn artificial intelligence that are going to benefit. Very happy to report that global diversification is working. Developed markets are positive this year, and U.S. stocks are down with something that's been a reversal that we've seen over the last several years, but it really reduces risk in a portfolio, greatly reduces risk, and we're really seeing it right now this year. Valuations, we talked in previous years and previous quarters that valuations in stocks are really getting lofty. The Mag 7 is still growing, and the valuations have really come in a good amount. So they're getting back to average, and that means that forward-looking returns for stocks are looking good right now. And they're still above historical averages, but they were getting relatively stretched. And we hear a lot of bad news with the tariff talk. But there's a possibility that we could have better trade deals leaving the tariff news than we entered the tariff news. If negotiations are positive and they seem to go well, and U.S. uses their bargaining power with global trade, that we could end up in a better spot than we started. And I think that that's something that's very discounted, especially in mainstream media. But when you think about all the possibilities, you have to, when you're thinking about, okay, I've got to think about a bear case. What can happen if things go wrong? What could happen if things go really well on the other side? You have to think about that too. But now we're getting into points of caution on the next slide. With tariffs, there is a possible return to a stagflationary environment. Nothing that we saw in the 1970s. That was an oil shock. This is going to be a tariff. If tariffs remain high, we can have a small uptick in inflation and a small downtick in growth. That is the definition of stagflation. That's a possibility that we're looking to face, but it just depends on how the negotiations go. We're seeing less people quitting their jobs, meaning that the labor market is continuing to tighten. People are getting scared about finding jobs or having difficulty finding jobs, even though we're at full employment. DOGE just is decimating some jobs in the federal government right now, cutting a lot of jobs. We're seeing it quickly roll over into actually real estate within Washington, D.C., just as a little bit of a wave from all of the cuts that they're having. But when you go back to March, the economy still added 228,000 jobs, which is really strong. So the private sector is making up for this. Something to think about, deficit spending. While we are having DOGE really look into that and to really try to cut some of that spending, it's something that if it continues, it can cause market concern, especially if interest rates continue to rise. So it's something we're watching, and it's on our minds. And also, with all of the news and how often the news changes from day to day, there is a heightened uncertainty with what we call headline risk, where we think something's going to happen, where we think a tariff's going to be a certain amount or it's going to be on certain goods, and the next day it changes to something completely different. So it is causing a heightened level of uncertainty in the market, and we're seeing that in earnings calls and companies. Companies are pulling back some of their guidance that they were going to issue. They say, we don't really know what's going to happen because we don't know what our prices of raw materials are going to be in the future. We don't know what we're going to be able to sell them for. There's just a lot of things that are changing within their actual businesses. And so they're seeing headline risk, we're seeing headline risk.
Absolutely. And we do have one question coming in. Apologies, we can't get to them all today. But Chad, I'm going to ask you, what will you be looking for? You mentioned the Fed might be lowering rates later on this year. So what kind of data do you think the Fed will be looking at to make those cuts? What would you be looking at, or what do you think the Fed might be looking at?
Yeah, the Fed is going to be looking to see if the inflation caused by tariffs is going to be, I'm going to say it again, transitory. I know that was a word that we had a couple of years ago. If it's going to be temporary, or if it's going to start a continuous level of inflation within the economy. So if we can see a blip in inflation and it's just a one-time event, then the Fed is going to be able to cut. And if they see that it's soaking in and kind of like causing a cycle, then they're going to have to keep rates high. As of right now, the market is pricing in cuts, maybe pricing in about 3/4 of a point cut by the end of the year, but it's really up in the air at this point. As we've talked about, there's just lots of changing headlines. But that's a great question, and there's a lot of interest rate uncertainty and a lot of inflation uncertainty right now.
So it's more about inflation than jobs, I guess, at the moment.
Yeah, it's interesting because they do have to balance. That's a great point. They do have to balance inflation and then the unemployment rate, because they can't really let either slip too much. And they're kind of butting heads right now because we're having lower growth and higher inflation. So the Fed did a great job coming out of 2022. This seems like an equally difficult job that they have ahead of them.
Okay, well, we know we'll be watching, Chad. Thank you for your time, and thanks to everyone for joining us today. We really do enjoy providing this information to everybody. And yeah, please give us a call. We love having conversation about portfolio and portfolio management and the economy. So please give us reach out when you'd like to. Thank you.
Thank you.